Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Today, we're going to discuss the 5 answers you need to put on a credit card application to trigger an approval or to receive a high credit limit card. There are 5 specific answers on a credit card application that can determine whether you get instantly approved or denied. And this is the part that most people do not understand. Credit card approvals, especially those with high limit cards, are not always necessarily about credit worthiness. They're often about how your answers are interpreted by automated systems and underwriting systems. Now, these systems are not emotional. They don't give you the benefit of the doubt. They simply scan your application for risk signals and they make a decision within seconds. I've probably helped thousands of people at this point get approved for credit cards that they never thought they would qualify for. Premium cards, high limit cards, business cards, and the same mistakes will show up over and over again, even with people that have solid credit scores and strong income. And I've spoken about this in various videos. I've mentioned how my credit score is in the 800s now, and I still get denied for credit cards for various reasons. So this video isn't about like a gimmick or a loophole or necessarily a hack. This is about learning how banks operate, how their algorithms read your application, and how to position yourself as a low-risk borrower using strategic answers. Now, by the end of this video, you'll understand exactly how to fill out a credit card application in a way that dramatically improves your approval odds and helps you qualify for higher starting limits and puts you in position to get cards that you actually want instead of just settling for the cards that you're allowed to get. Let's start with the first answer that triggers more approvals than almost anything else. The first question is employment. Now, this one seems obvious, but you'd be surprised how many times people mess this up. When a credit card application asks you for your employment status, the question carries far more weight than most people realize. In today's lending environment, more than 80% of credit card applications are decided entirely by automated systems. That means your answers are not being interpreted by a human who understands nuance. They are being interpreted by code. So from the algorithm's perspective, stability matters more than anything. Predictable income matters, consistency matters, and unfortunately, certain perfectly legitimate employment categories are coded as high risk. Now, there's one section of this part of the application that I have noticed has changed, and that's self-employment. Now, you've probably heard that being self-employed actually hurts your chances of approval. I believe that's outdated and incomplete information. Banks don't dislike self-employment, they dislike instability and unpredictability. What matters is how your employment status aligns with your income and your tenure. So people who consistently get high limits while self-employed understand this. And if you're self-employed, a business owner, or maybe you're an independent contractor, you need to signal longevity and consistency. So that means entering your total time in business, not just the age of your current LLC. Banks care more about how long you've been generating income and not how long a piece of paper has existed. So the biggest mistake that people can make is entering high income with extremely short employment durations. That combination will trigger risk controls. So for example, someone entering $90,000 in their income section with 3 years as a business owner does look stable, whereas someone entering $120,000 who's 3 months self-employed, that'll look very, very risky. The answer needs to make sense together. Banks are pattern detectors, not lie detectors. Now, if you select self-employed or retired, you're statistically more likely to be flagged for additional review. So here's the approach that I take. When the application asks for your employer, you should list your business name. If you don't have a formal business name, just create one. The system is not validating the business, it's validating structure. The same logic applies if you're technically retired but still generating income. Consulting income, rental income, gig work, part-time work, side income, all of this counts as employment activity. The goal is to communicate that money is still coming in on a reoccurring basis. You're not misrepresenting yourself, you're accurately describing your income producing activity in a way that aligns with how banks assess risk. This single adjustment alone can be the difference between an instant approval and an automatic denial. But employment is only the first filter. The next question is where most people either shortchange themselves or raise unnecessary red flags. The next answer that determines your credit limit is income, but not in the way that most people think. Banks don't use income as a character judgment, they use it as a ceiling calculator. When you enter income on a credit card application, the bank typically will divide that number by 12 and then applies an internal multiplier to determine how much exposure they are willing to extend across all accounts. If you artificially lower your income, you are literally capping your own limit. High limit approvals consistently come from people who understand three things about income. First, banks want gross income, not net income. So that means the income before taxes, before deductions, and before expenses. If you made $70,000 last year, but reasonably expect to make more this year due to raises, bonuses, or business growth, you're allowed to report that projected income. This is explicitly stated in the fine print of most credit card applications. Reasonably expected income is allowed. Secondly, banks do allow household income. If you're over the age of 21 and you regularly use money from someone else to pay your household expenses, then that income can also be included. This applies to spousal income, partner income, or family support, as long as it's consistent and available to you. Now, this is especially important for younger adults who are still building independence. If bills are being paid with shared household income, that income does count. There's also powerful adjustments that many people miss when it comes to non-taxable income. Certain income sources such as disability benefits or veteran benefits are not taxed, and because of that, banks allow you to gross up that income approximately 25% when reporting it, since non-taxable income has greater purchasing power than taxable income. Third, consistency does matter more than perfection. Banks compare your stated income across applications, across bureaus, and across time. So where people get into trouble is exaggeration. Income must make sense relative to your existing credit profile. If you report a very high income, but your credit report shows low limit credit cards, small installment loans, or financial stress indicators, the system may flag the application for manual review. Manual review is not always a bad thing, but it does increase scrutiny. That can lead to the request for documentation, income verification, or financial reviews that you don't want to deal with. Now, the safest approach is for you to report income that is accurate and reasonable, income that's consistent, and that fits overall with your financial picture. Income helps determine starting limits. It does not override risk. Now, for those of you who are self-employed, you're contractors, you're a business owner, there is the option of producing your own paycheck stubs for your business. I have an entire video about that. I'm going to link that video right here. That is something that I do as a self-employed individual. So if you run into an application where, let's say, you don't just want to list that you're self-employed because you feel like it may scrutinize you, then check that out. You can create your own paycheck stubs legitimately, and then you can use those in case you run into a manual review. And that brings us to the next critical answer that quietly affects approvals and credit limits. This is one of the most important answers on the entire application, and almost no one talks about it publicly. Your housing payment plays a major role in how banks assess affordability. Now, this is especially important for renters. Banks will subtract fixed obligations from income to determine how much available exposure you realistically have. If you own a home, your mortgage usually shows up on your credit report, and that means that lenders already see it and factor it into your debt to income ratio automatically. Rent is different. In most cases, rent is not reported to the credit bureaus. That means when you list your housing payment on a credit card application, the bank has no independent way to verify it. They rely entirely on what you report. This is where many people accidentally sabotage themselves. So if you split rent with a roommate, a partner, or family member, you should only report your portion of the rent. Reporting the full household rent makes it appear that your expenses are much higher than they actually are. The same applies if you live with family and you do not pay rent. In that case, the answer is 0. That is a valid and accurate answer. When you overstate housing costs, you inflate your debt to income ratio on paper, and that makes you look financially stretched, even if you're not. And that can result in lower limits or denials, especially for premium credit cards. Accurate reporting helps lenders see the true picture of your cash flow, and that accuracy works in your favor. Now let's move into a category that becomes especially important for business credit cards. When applying for business credit cards, the way you describe your business matters more than most people realize. Banks will classify businesses using industry codes that signal risk levels. Certain industries are flagged as high risk across the entire banking system, and this includes things like real estate investing, cryptocurrency activities, cannabis-related businesses, gambling, adult entertainment, and credit repair. Now, that doesn't mean that these businesses are illegal or unsuccessful. It means that banks associate them with higher volatility and regulatory exposure or chargeback risk. When you list one of these industries directly on an application, you increase the likelihood of manual review or denial. The key is to focus on low-risk mainstream aspects of what you actually do for your business. So for example, many real estate investors also provide consulting, education, or property management services. Those descriptions are far more bank-friendly, and you're framing your business activity in a way that aligns with how banks would assess risk. Every legitimate business fits into multiple functional categories. Your job on an application is to choose the description that accurately represents your activity while avoiding unnecessary risk flags. This single adjustment can significantly improve your approval odds for business credit cards, especially with major issuers. I have an entire video on NAICS codes or NAICS codes. If you guys want to check that video out, I'm going to link it right here. That video will give you an idea of how to find the least risky industry codes. But even if you answer everything correctly up to this point, there is still one mistake that can undo all of it. Applying for a credit card without reviewing your credit report is like showing up to an interview without knowing what's on your resume. Now, you may think that everything looks good, but lenders see the full file, and that includes old accounts, forgotten balances, late payments, and reporting errors that you may not be aware of. So before applying, you should review your credit report from all three major credit bureaus because every detail matters. Your name, your address, your account statuses, your balances, and payment history, they all need to be accurate and consistent. Now, I recommend that you use rising.com. If you check out their website, they give you a full tri-merge credit report that shows all three bureaus, and you can actually see if the information is consistent across all three of them. Now, you can start a trial for $1 for 7 days to get all three of those reports. I'll put a link down in the description. Even small discrepancies can trigger delays or denials. Inaccurate negative items should be addressed before applying for new credit, and cleaning up your credit profile ahead of time will put you in a position for instant approvals instead of waiting weeks for a decision that may still be a denial. I also have dozens of videos on this channel breaking down how to review and repair your own credit. So if you're serious about approvals, then this step is non-negotiable. Credit card issuers all have their own internal rules, and approval is not just about your credit score. It's about timing, relationships, and alignment with issuer criteria. Some banks limit how many accounts you can open in a certain period of time. Others restrict how frequently you can be approved, and these rules exist to manage risk, not to punish you. Building relationships also does matter. If you're already banking with an institution, applying there first can improve your odds. Existing customers often receive more favorable treatment. And if you're new to credit or credit building, secured cards can also be a powerful stepping stone. They establish positive history and open the doors to better products later. Pre-qualification tools also help you gauge approval odds without hurting your credit score, and they're not guarantees, but they do provide some valuable insight. All right, I want to thank you guys so much for watching this video. If you want to learn how to identify and fix those issues, I have that credit repair playlist down in the description. Don't forget to sign up at rising.com. You can get all three of your credit reports for $1, and that's going to be for 7 days. And if this video has helped you understand how to position yourself for better approvals, make sure that you subscribe to the channel because this is exactly what we do here. I want to teach you how to actually use your money, your credit, and banks to actually work for you and not against you. And that way you can do whatever you want as far as your financial future is concerned. Once again, thank you so much for watching this video, and you guys have a wonderful day.